Morning, everybody, and welcome to the CBRE-Albany 2021 Marketview event. My name is Richard Slaseman. I'm the president here at CBRE-Albany, and this is the 11th year we are putting on our Marketview event, bringing you sort of the trends and what's going on in the Capital Region commercial real estate market. Last year was our 10th year, obviously, doing it, and it was, I believe, the last time, at least for me anyways, I was in a public gathering. So obviously a lot has happened in the last 12 months in the world, in our area, and certainly in commercial real estate. Two phrases have come up during this 12th month. One is the word Zoom, right? So it's become not only a noun, but a verb and part of our nomenclature during the last year. Of late, the other phrase that's come up is the phrase Zoom fatigue. So we're going to try to avoid some Zoom fatigue for you folks here today by giving a little bit of a different perspective. We're not going to bury you today with slides and graphs and charts. We're going to have a conversation about what's happening in the capital region real estate market. And to have a conversation, we're going to have somebody here lead us in that discussion. And it's somebody that many of you know from being with us in the past for this event, and that is Spencer Levy. Spencer is the chairman of the Americas Research and senior economic advisor for CBRE. But more importantly than that, from our perspective, Spencer is a good friend of ours and always there for us when we ask him to join us. And he is a fan of the Saratoga scene, which makes him even more special in our hearts. So this morning, joining Spencer is going to be a panel of CBRE-Albany associates to discuss with you and with Spencer what's happening here in our area. We're going to have Eric Simons talking about the office market. We'll have Dan Simpson discussing what's been happening in the industrial field. John McCaffrey will pick up the retail conversation, and Lori Tylinda is going to be bringing in the angle of the investment and capital markets to the conversation for us. So we're excited to share with you our thoughts of what's going to be happening in the area, what's been happening, and where we're kind of headed. So normally I would say to Spencer, the floor is yours. However, this year I have to say, Spencer, the screen is yours. So thank you, Spencer, and take it away.
Well, thank you, Richard. And I'm going to keep my comments fairly short at the beginning because GameStop starts trading in about 20 minutes. And so I just don't want to miss that opportunity. But I am going to speak for about 10 minutes, and then I'm going to interview our friends in the Albany region in the various asset types, industrial, office, retail, and capital markets to try to get to the bottom of where we are and where we're going. But starting from where we are and where we're going, I'll give you a 10-minute overview of that. And this will be the shortest economic overview of all time. 2021 will be better than 2020. That's about all you need to know at the moment, because right now at the moment, you probably don't feel that. You probably don't feel that because, as the expression goes, it's always darkest before the dawn. And the dawn is not coming until the vaccine takes hold. The good news is that we are seeing, while there's been a rocky rollout of it in various places, we got some very good news out of the UK this morning. And I think we're going to continue to see good news. The numbers are starting to go the right way. So we are confident that by the summertime, we will all be in Saratoga in person. And hopefully this year I don't lose money like I did last year. But the point is this, is that things are getting better because of the vaccine. And I will tell you that where we were right, where we were wrong in our predictions. We were wrong about where we thought we'd be today. We thought the US was not vaccine dependent. Obviously it is. We thought we were going to follow the Asian model of testing, tracking technology. That was wrong. And so because of that, we had to push out our forecasts, both from a macroeconomic perspective and then from a micro perspective about what's going to happen for real estate. And so there's good news and bad news in that. All right. So the bad news is it pushed out our forecast. The good news is we've seen, because it's taken longer to get back to some sense of normalcy, we've seen much more fiscal stimulus, number one. And number two, our forecast for a very good 2021 has now bled into 2022 as well. And so just to give you a few round numbers, we believe that 2021 is going to look at GDP growth approaching 5%. We think that 2022 is going to be approaching 4.5%, which are both excellent numbers by any historic metric you would look at. Now, why are we seeing more stimulus? Well, let's talk a little bit about what happened just in Washington a few weeks ago with the change in administration. A lot of good news there, but there are some things that may want to take into consideration on the negative side as well. The good news is that because of the change in administration, because of the flip of the 2 Georgia Senate seats, so that the Democrats now control all 3 houses of our government, stimulus expectations went up. And where does that show up? It shows up in the stock market. It shows up in the bond market. And no, GameStop has nothing to do with that. It is a completely different phenomenon. If anybody has any questions about that. But the bottom line is the market is responding very positively to it because they believe we're going to grow faster through the increase in fiscal stimulus and then the potential for an infrastructure package to follow. Now, we don't know if it's going to be 1 trillion, 2 trillion or more, but it's going to be more. And more is good because we need as much wind in our economic sails as we can get. Because unfortunately, notwithstanding the fact I'm giving you a fairly positive picture of the future, there's going to be some significant damage that's going to take years to overcome. Starting in the restaurant sector, where up to 20% of restaurants will never reopen. In the hotel sector, where in New York City alone, we're going to lose at least 20,000 hotel rooms permanently. I was on a phone call yesterday with the head of the American Lodging Association. I think it's 25,000, whatever. We're all talking about numbers that are unfathomable, but nevertheless, so the damage will be done, and we need as much economic stimulus to push us forward. Now, the negatives of the new administration are the concerns over taxes, over regulation, and specifically to our industry, the potential to lose the 1031 exchange. And for those of you who are traders of assets on this call, you'll know how important that is. And I'll give you a few round numbers on that. Last year in CBRE's multifamily book, 30% of our trades were 1031. Our industrial book, 21% of our trades were 1031. So you could see that if that should happen to go away, it would significantly impair the commercial real estate trading market, which is the bad news. The good news is those numbers are inflated because really 1031 is most important in down markets and up markets. It's still important, but not nearly to that degree. Now, I hosted a call a few weeks ago with Dave Camp, the former chairman of the Ways and Means Committee of Congress, the Real Estate Roundtable, and others say, well, what are the odds of this stuff happening? Well, I guess the good news from the standpoint of it's not going to be that bad is that because it's such a tight split within Congress, according to the roundtable, there are many quote unquote Republicans in Democratic clothing in the Senate. And so the worst impulses of regulation and taxations will not come to pass, number one. And number two, if we do see these tax increases and or the potential to lose the 1031, the most likely scenario is it would not be till next year, not in calendar 21, which is really important for everybody here who's trying to make decisions on whether or not to sell or make a major capital decision in 21. Should not be impacted. Is there a chance it could happen in the fourth quarter? There's a chance, but everybody thinks it's not going to happen until 22. The other thing that gives me comfort is our new Treasury Secretary, which is Janet Yellen, was the former Fed chair. I was a huge fan of hers then. I'm a huge fan of hers now, in part because she's very, very much known as a dove. She is going to let the economy run hot longer in terms of not pushing up taxes, in terms of not pushing up other factors that could slow down growth. So 21 is going to be a good year. 22 is going to be a good year as well, economically, assuming our base expectation for the vaccine holds and we are out of the woods sometime in mid-year 21. So very briefly, what's going on in the major real estate asset classes. So look, you know what's good and what's not. And what's good is industrial and multifamily. And I know that our teammates here on the call are going to talk more about that for the region in just a moment. What's not so good is retail and hotels, which we talked about. And the one in the middle is office. Office is where we're getting all of our questions about, because of this work from home Zoom thing, is it durable? Will it not only change the future trajectory of office demand, will it change where people live, work, and play? And these are all questions we're asking right now. Now, I'll give you my point of view based upon the research we've done, and I'm happy to share all of this with you. From our point of view, we believe that work from home will impact some office demand. It will impact some places where offices are, but nowhere's near the degree that most people feel in their guts today. Let me cut to the chase here, folks. I'm a Gen Xer. I grew up in early 1980s rock and roll music. There was a band in the early 1980s called Asia. And Asia had a song called The Heat of the Moment. What was that song about? It said that in the heat of the moment, you make bad decisions. And where are those bad decisions showing up? In the surveys that we're seeing and saying we're never going back to the office, or in the statements of the CEO saying your employees never need to go back. We believe strongly that in 6 months from now, once people are back in the office, those surveys are going to change materially. Now, we will still see a diminution in some demand. What we will not, the future is going to look a whole lot more like the past than people think. Now, what are the changes to office? We're going to see obviously a rise in wellness, rising to the levels that we saw for security post 9/11. We're also going to see an increase of what we call hub and spoke, where while most offices are still going to be located in the central business districts of the existing cities, we are going to see some more people working in suburban areas, but not in a permanent office address, probably more in flex space, even though flex space, because of the travails of WeWork, had a tough go of it during the crisis. We think the future of flex space is brighter post-crisis than it was pre-crisis, because companies are now looking to use their excess space needs in flex rather than in excess space and direct space lease. As far as the rise of secondary markets, that trend is durable. We are seeing people go from some of the major coastal markets into the Nashvilles, the Denvers, the Raleighs, the Charlottes, the Orlandos, the Tampas. Listen, I can go on for days about this, and that is durable, but you should know that markets like New York and the capital region would include it, are still going to get a disproportionate amount of the most highly educated, highly talented professionals. And that would apply to California as well. So while there might be a net outflow of the gross number of people, the most highly talented, highly productive folks are still going to flow to places like New York, like California, like Chicago. So there is still good news, notwithstanding some of these durable trends. So the last thing I'm going to mention before I bring my friends in to talk more specifically about the capital region is pent-up demand. Pent-up demand is what is going to save the world from an economic perspective. What is pent-up demand? People want to spend, and they want to spend on retail. They want to spend on hotels. And my good friend over in Asia, Henry Chin, who's in Taiwan, said there is something over there called revenge retail already going on now. People buying luxury goods because they want to get out and spend. And you know who wants to get out and spend and go to hotels? I do. You know who else does? You do. So let me just ask all of you one simple question. Who of you on this call wants to get back on a cruise ship? By show of hands. And by the way, I can't see your hands, but I'm guessing there are no hands up right now, but mine is. You know why my hand is up? Because getting on a cruise ship is awesome. And I will also tell you that I am the research guy, and in advance of this call, I did some research. I took a look. Well, what's it going to cost me to go from Miami to the Bahamas for a 3-day cruise on Carnival Cruise Lines once they reopen back in the summertime? $139. You know who's getting on that cruise ship? A lot of people. And thank God for it, because 2/3 of the American economy is related to the consumer. The other 1/3 is business and government spending. So pent-up demand is what's going to drive us forward. We think there's going to be, in the words of Fritz Kagi, who is the chief tax collector in Cook County, Chicago, the mother of all comebacks in the second half of this year. I'm optimistic that that is going to happen, and I think the capital region will be a beneficiary of that. So with that summary of where we are, I would now like to invite my first guest on the show. I say the show because I host the Weekly Take, CBRE's podcast, and can't help but saying that sometimes. But Dan Simpson. Dan is going to talk to us about industrial in the capital region. Dan, how are you today?
Good morning, Spencer. I'm well, and the industrial market here in the Capital District is even better.
Well, I believe that because I've been following industrial nationally, and I've been calling it the land of milk and honey compared to all the other asset classes. Is that a fair characterization?
I think it's very fair. We finished 2020 with an overall vacancy rate in the industrial market at 2.7%, down from just a few quarters earlier at the end of the first half of 2020, when that vacancy rate was 3.5%.
What's driving all this demand?
Well, much like the national trend, we mirror that somewhat in that e-commerce, third-party logistics, and last mile fulfillment are drivers. In the third quarter of 2020, we saw the ribbon cutting of Amazon's 1 million square foot fulfillment center in Rensselaer County. We saw smaller, but again, Amazon leases in Albany County and Montgomery County.
Now, are we seeing any expansion of what I would call institutional grade industrial? You mentioned last mile. We're also seeing some subsectors like cold storage. Seems like not only is it popular, but the industrial sector is getting bigger. You agree with that?
I do. And again, keeping in mind that Albany is a tertiary market, we do mirror the national economy and some of those drivers to an extent. But I looked at all of the sales that occurred in the industrial market, both investment and by owner, user, occupier. And the predominance of the activity on the purchase side were by owner users, with the most notable category being building materials and the mechanical trades of HVAC, plumbing, and electrical. Probably the second category after that in the owner occupier purchaser was food and beverage and those related entities.
Well, that's good news, because I think, you mentioned earlier on the 1,000,000 square foot Amazon facility, but the demand drivers here are much deeper, much wider than just e-commerce. And I would say, and I know I'm going to speak to Lori in a few minutes about the capital market side, the buyer universe, while a disproportion of them might be owner operators, we're also seeing many more buyers entering that space that might have historically been in office or retail. Is that true?
Yeah, that is true. And the interesting thing was in 2020, we didn't see as much institutional investment in the industrial market because I think it was a situation of constrained product. We did see in early 21, which obviously we'll talk about next year, a significant asset that was purchased by institutional money in the investment category. But again, I think it was just merely lack of supply. We did see some local purchasers, and not to tread on Lori's territory, but we did see some local purchasers purchasing industrial investments where they're repositioning them and reinvigorating those bricks and mortar to get ready for the next wave of industrial.
Well, speaking of that next wave of industrial, I had a national call a couple of weeks ago, and I was speaking with some of our leaders in the industrial practice globally, and things were so good. I had to ask the uncomfortable question: can things get better in industrial? Can cap rates get lower? Can we see more demand? What's your point of view about the future, Dan?
I think the demand will continue. We're seeing a push up the mid-Hudson Valley into Albany. A market such as ours, typically we see very little speculative construction with a few notable exceptions. Southern Saratoga County, we saw it, the Gillespie Group over in Schenectady, always an active player in the market and always poised and ready with some amount of speculative construction. Those drivers were anxious to see them continue. And Spencer, you made the 80s reference of Asia, and I had that album on vinyl. I'll make the reference to the 80s with the Kevin Costner movie Field of Dreams, and that is build it and they will come.
Well, that's an excellent way to sum up the comments about industrial, because I started this was saying it's a land of milk and honey. You're entering it with the Field of Dreams, build it and they will come. I'll give you one other plug for industrial right now. I've been in this business for almost 30 years. And, when I go to these industry conferences, I used to figure out who to hang out with. And it was always an order of people to hang out with. You started with the hotel people because they knew the cool places to go. Then you hang out with the retail people because they knew the good restaurants. Then the office people. And at the bottom was the industrial. It's all on its head. You're now the coolest kid in class to go along with everything else. How about that, Dan?
Well, after 25 years in this industry, I'm happy to be at the head of the class.
All right, Dan. Well done. Well, thank you very much, Dan. We're going to have Dan shut off his screen. He'll be back at the end for a lightning round conversation. But I now want to turn to my good friend, Eric Simmons, and we're going to talk about the office market in the capital region. Eric, how you doing today?
Spencer. I'm well. How are you?
Doing terrific. Great to see you. And I'm still mad at you for those bad picks you gave me at Saratoga 2 years ago, but I won't hold that against you.
Keep going with GameStop. You'll recover your losses.
Thank you very much, Eric. So, Eric, how's the office market doing in the capital region?
Well, the office market is, well, as you said in your opening, it's kind of uncertain at the time. Traditionally, when we look at the office market, we look at three basic metrics, which are inventory, vacancy rates, and asking prices. And if we look at inventory first, we're basically steady in the capital region at 30.5 million. We had a net gain of 20,000 square feet, which was largely the result of adding about 150,000 of medical office space and subtracting a bunch of square footage for conversions and repurposing of older dated office space in our downtowns.
Well, what conversions to what?
Residential mostly.
Mm-hmm. So
which is a trend that's been building for years here.
Mm-hmm. Well, there's a shortage of housing, and I could certainly see why we would want to do that conversion. We're seeing that conversion not just in the office sector. I think we're seeing it more in the retail sector as well, but nevertheless, the office sector is seeing a lot of that to get rid of excess demand. Which brings me to the $1 trillion question, which is demand. What are we seeing right now in terms of the activity of existing tenants, and are we seeing any new demand in the region at the moment?
Well, the second question first, the new demand seems to be largely driven by medical office users. Like I said, there was about 150,000 square feet of new construction. Saratoga County specifically has seen an explosion of medical office construction and demand for existing buildings. And I think we're going to continue to see that into 2021. If you look at the planning board agendas, there's several 100,000 square feet of medical office related construction projects on the books.
Well, you know, one of the things that's great about the capital region is that it actually has a diversified economy. You have obviously the state seat up there. You've got some terrific universities up there. And now you mentioned medical as well. Any industries that you could point to beyond medical that you see as growth drivers in the region?
Yeah, certainly the state government is very active in leasing office space and industrial space. Our hospitals, our university systems, they all create the stability that our area, while we don't have big upswings in valuations, we also don't experience the major downswings either. So steady as she goes is how the region works.
Well, my dad told me a long time ago that slow and steady wins the race. So maybe that's a good thing, particularly in down markets like we're in at the moment. But let's get into some of the fundamental issues about office for a moment. I mentioned work from home. I mentioned flex space. What are the trends you're seeing in the capital region? So let's start with flex space. Are we seeing an increase in demand for that? What's your point of view?
Yes, we are. And I think that that's only going to continue because, as you know, that's estimated that 30% of the workforce is going to be some sort of combination of in-office or work from home. But here in the capital region, we have a lot of satellite offices of major corporations. And I think we're going to see, and we have seen, some of those offices close permanently and go remote. And I think those corporate office employees are going to end up realizing in time, if they haven't already, that eventually they're going to want somewhere to go, and they're going to look to those flex operators for those space needs.
Well, the trend we've been seeing on that flex is exactly what you're suggesting, is that a typical office occupier would lease, let's say, 10 to 20% excess space in their direct lease. And now, well, I hate to say it, but cost is king at the moment. They're trying to knock that number down to 5 to 10% and use that excess 10% or so of space in this flex arrangement. And a lot of people, I think, have a misconception of flex. A lot of people think it's all high density membership type model. It's not. A lot of it's demised. So, Eric, when you are advising our clients in the capital region how much flex space they should have in their projects, what do you say?
It really depends. How are their employees working today? How do they want to be working in the future? And where are they located? When we look at our offerings, just last year, Spencer, we had 6 new flex operators open their doors. We had Rosenblum's Co-works in suburban Albany, Peacock's Business Hub in downtown Albany, First Columbia's in Century Hill, and several others, Saratoga, Schenectady. So there's so many options, and it depends a lot on the individual person, I think, of how they want to be working.
Okay. Let's talk about another issue that we've been seeing nationally. I'm going to use a very technical term for you here and right now. Forgive me for this. It's called kicking the can down the road. That is the primary strategy we have seen among our office tenants nationally, really not doing anything of note, and they probably won't until 6 months from now. Is that the same phenomenon we're seeing in the capital region?
Yeah, it is. And I'll start with saying that predictions made in times of crises are notoriously unreliable, but what the hell, I'm going to do it anyway. As I mentioned, medical office expansions are certainly a huge driver here, but traditional offices, I think that office perks and amenities are the key to bringing workers back to the office, and those are going to be the best performing assets. We'll see continued de-densification of spaces. Office layouts will change. But there's going to be increased opportunities to find below market sublease opportunities as well. So the good news for the office tenants on this call today are, if you're in the market for space in the next couple of years, you're going to have a great opportunity to either flight to quality, increase the quality of your space, or lower your overhead, or maybe both.
Well, you know, it's interesting. I just saw the numbers this morning from San Francisco, and while they're showing a material increase in sublet space, they're not showing a lot of direct vacancy. A lot of people blowing out of their leases completely. People saying, well, we'll just let this expire. Are you seeing any of that in the capital region?
A little bit. Specifically, I saw one tenant that was in 7,000 square feet, had planned pre-pandemic to go to about 20,000 square feet. And then in May of last year decided we're no longer expanding to 20,000. And in fact, we terminated our existing lease. We're 100% remote. However, we saw the opposite side of the coin, where a tenant who was looking in the market for about 13 to 15,000 square feet, they ended up leasing 22,000 square feet to accommodate social distancing. So it cuts both ways.
Well, that's really, I think, the punchline here of you know, if there's a silver lining in this calamity, is that while there may be some tenants who are going to work more from home, some of the existing tenants are going to take more space for less density. So last question, Eric, before we turn to the retail asset class. Eric, new construction, what do you see on the horizon? Where is it, if any?
Again, it goes back to medical office, and we continue to see this. I think the president's aggressive agenda to increase healthcare spending is driving a lot of the medical demand, and we're seeing that here in the capital region when no matter where you are, you drive around and you'll see now urgent care centers popping up all over. And it gets into the question, and maybe you can talk about this with John shortly, but these are medical offices that are located in residential, or retail centers or retail pad sites. So is it considered medical office still, or is it retail that's being used as medical?
Well, I think that brings up a key point, which I'm going to talk about with John in just a moment, of live, work, play. The definition of what is retail, what is office, what is multifamily, they're getting fuzzier for a good reason, because I think that's the type of environment that people want.
That's right.
Well, Eric, thank you very much. I'm going to ask you to step back for a moment. We'll bring Eric back in a little bit. I'd now like to invite to the stage my friend John McCaffer. John, how are you doing today?
Good. How are you, Spencer?
Good. Well, John covers the retail space. Why don't you give us a broad overview? What's going on in retail in the capital region?
Well, it's been an interesting year. It'll just turn on the news or drive down the street, see who's open, see who's closed. It's been again, both sides of the coin here. For some retailers, it's been a banner year. For the online retailers, for your essential services stores, your Walmarts, your grocery stores, they've had record years. For your smaller retailers, your restaurants, it's been devastating. Some of these malls were closed for 3 to 4 months here in New York at the early pandemic. Those guys, it's hard to recover a lost quarter to a third of your business for a year when you're not open. So there's a lot still to be seen, I think. I believe what really has happened this year is it has driven in the retail market what has been coming for the past 5-10 years that we've been talking about: online sales, omni-channel delivery, the Amazons and the Amazons of the world bringing everything to your doorstep, or in a mixed format. I mean, the interesting thing is the second Amazon store in New York State is opening today in Crossgates Mall. There is your online company opening a bricks and mortar store in our market. Whereas the rest of these retailers are trying to figure out how to get out of their brick and mortar stores and get more online and deliver the goods to their customers. We have seen, you've got, Walmart with their home deliveries. All of these guys are going into it, and the smaller retailers are trying to figure out how to capture that, and the curbside deliveries in our strip centers, and they, working with their landlords to set up parking spaces for them, have really been what it's about.
Well, John, let me give you a somewhat more optimistic, maybe a little bit of a counterpoint of view.
Okay.
So this, in what I'm sure will be one of many shameless plugs for my podcast, The Weekly Take. I had on my podcast the other day, Joey Agree, the CEO of Agree Realty, which buys retail. And it bought a record amount of retail in the third quarter of last year, of 2020, during the pandemic. And you know why? Because they were buying what they called four-wallers, where they had traditional bricks and mortar in the front, industrial distribution in the back, and maybe some services that can come out of the store. Do you see that type of retail thriving in the region?
I see it getting here. I mean, prime example is the Sears box in the Rotterdam Square Mall. United Auto bought it. They're going to have their store in the front, their offices in the middle, and their distribution center in the back in what was 100,000, 110,000 square foot, Sears. Which brings us to the discussion of, the standalone boxes that four walls works very well for. The freestanding Staples or the freestanding Walmarts that can take part of their space, convert it to that industrial or distribution side of it, and still get it out the door. There has been a lot of discussion about the big box conversions and the big box conversions on the malls. The problem at the malls with those conversions are often the box is owned by the tenant, the mall owns the parking lot, you've got zero lot line issues, you've got zoning issues, so you've got loading dock issues and how to install them into retail fronts without cutting into the parking where the people are. On the standalone boxes, I mean, Walmart nationally has declared they're taking 25% of their store space and converting it to delivery, e-commerce, whatever, non-traditional retail sites or spaces. So we're beginning to see it here. But, when we're seeing the conversion, as you said, live, work, play, Windsor and Clifton Park has proposed take down the old Kmart and convert that to apartments attached to their shopping center. You've got Wilton, Saratoga Hospital moved their back offices into 50,000 square feet of retail space in an empty box. So we're seeing a real mix.
Let's shift now to strip centers, neighborhood centers.
Mm-hmm.
Clearly, some of them are performing well, these segments of it, the grocer and the pharmacy, but the inline space more challenged. I believe that Dan brought it up or Eric brought it up during his comments about maybe some docs in a box going there, medical or distribution, some form of light industrial. What are you seeing filling some of these dark inline spaces in these strip centers?
Well, I mean, and that a lot of that remains to be seen as to who comes back. It's scary because you've got a lot of retailers sitting in spaces right now, that we don't know they're paying full rent, paying partial rent, how they're ever going to recover the half rents they may be paying now. But we are seeing an increased activity in the medical users, the urgent cares, the physical therapies into these spaces. What we haven't seen, but I think what is coming is these possible co-working spaces or flex uses, because the amenities are there. The parking is there. Why wouldn't you pull up, go into your office and have 3 restaurants, up and down the strip for you to use? Or will you see these flex spaces go into the upstairs of the empty Sears at Colony Center? Pop in a few windows, it could be really nice office space and they can walk, your employees can walk out in the mall for lunch. So it's going to be an interesting evolution. But, overall, the local activity, what we're seeing, it's still the beauty, the hair, the things that are starting to come back now that the governor has, opened those things back up. Very little in the restaurant user activity space, except some of the quick serves.
Right,
But
let me point to two neighborhoods for you. I'll point to downtown Albany. I'm also going to point to Saratoga Springs, which I would call both of them different versions of urban retail.
yes,
How's urban retail doing? I'm sure it's struggling, but what do you see as the future of urban retail, restaurants or other users or otherwise?
I mean, traditionally here, because our cities are relatively small geographically and closely connected to the suburbs where you have your traditional boxes and groceries. So you don't see a lot of that coming into our downtown urban retail. Our urban retail is traditionally your smaller convenience stores, maybe a drugstore, nightclubs and restaurants. I'm thinking up and down State Street and North and South Pearl Street in Albany, or up and down Broadway in Saratoga. Broadway in Saratoga, again, is unique. Saratoga is different than the rest of our really downtown so far. The rest of them seem to be trying to copy and emulate it, which is a good thing. It's been very successful in Saratoga. But even there, we're beginning to see some holes. And we haven't seen a big dip in the asking rents, but what we don't know yet is what are those asking rents going to turn into as far as lease rates in the future.
Well, let me ask a broader question for a moment. Everybody knows how great Saratoga is in the summertime during the racing. You got Lake George up there. Lake Placid's not far away. We are hearing a lot of people moving from New York City upstate. Are you seeing much of that? And do you think that might positively impact retail over the long term?
We are seeing a lot of it, and based on people I talk to, a lot of the people that have moved into downtown Albany to a couple of the office conversions to residential lately seem to be people who can work from home, coming out of the New York City area or out of the Boston areas where they can live, hopefully work and play eventually once things open back up, at a much cheaper rent than living in a 900 square foot, $4,000 a month apartment in New York City. So we are seeing people with second homes moving into them more in the woods. We are seeing people move up here and buy home, suburban homes, move their whole families up here to get into the school districts if the breadwinner is capable of working remotely.
Right. Well, I think the loss in office, the potential loss in office, is a potential gain in many of these suburban tertiary locations, because I do think there's going to be some permanence to people moving there, if not necessarily full-time, certainly for longer than they had done in the past. So I think the future of retail in these types of regions like yours, John, will be brighter once we're past the pandemic, with a higher population base there on a more regular basis.
I agree.
Great. Well, John, thank you very much for your overview of retail. I now would like to introduce, if you wouldn't mind coming off screen, we'll bring you back in a moment, John. But I would love to bring Lori Talenda to the screen. And Lori, we're going to talk capital markets. Lori, how you doing today?
Good morning, Spencer. I'm doing well. Much better today now that I don't have to shovel.
Well, there you go. I've been shoveling out here too, but hopefully it will stop snowing. It actually just did stop snowing. So Lori, tell us about how the capital markets are doing in the capital region.
So in the capital region, we did well last year in the second half with the capital market sales, and it was led by multifamily, industrial, and retail. For retail, as you were just mentioning with John, a couple of our sales included the grocery. So we had ShopRite and then the small neighborhood plaza with a Trader Joe's in it. We also had a Bank of America and another neighborhood shopping center in Bethlehem that sold. On industrial, we had several transactions. There was 21 Airport out in Glenville, which was a single tenant new construction property. We had 10 Jupiter, which is again a single tenant building with a shorter term lease, but a strong tenant in the building. And Charles Park, which that was a 6 building property asset that traded. And then recently, as mentioned earlier, the FedEx building in Manans just sold.
Great. Well, Laura, give me a sense of pricing pre and post pre-COVID and today. About the same, big reduction. What's the trend?
It's about the same. The cap rates have really held pretty steadily. Not much movement, but we're thinking that depending on the strength of the tenant and the length of the term, there may be some downward compression on the cap rates, just a bit.
Let me reiterate that last point you just made there. Downward pressure on cap rates during a pandemic. Does that surprise you? And do you think it's going to continue?
Well, I think part of the reason for that is you mentioned earlier about pent-up demand, and there are people who are looking for product. There's not a lot of product, especially for these asset classes that are in demand, and the interest rates are attractive. People are also looking to diversify their portfolios.
Well, speaking of asset classes that are attractive, you did mention industrial, multifamily. You did sell some retail, which is good, which goes back to my Joey A. Grease story. Who's buying these assets? Are we seeing mostly locals, or are we seeing some people from outside the region?
We're seeing a mixture. So we do have our local investors that have been active, which is always great to see. And over the last several years, there's been a continued trend of people from outside our market looking. In particular, we have a lot of investors from the New York City area, but we've also had investors from California and even China be purchasing lately.
Well, I think that trend of having Asian investors coming in is all over the place. I've sold actually several large office buildings to investors from Singapore, South Korea, and they're all looking for the same thing. They're looking for yield. And I think that the capital region certainly can provide that. So give me a sense of the yield difference between buying, say, an industrial asset or a multifamily, the two most liquid asset classes right now in the capital region versus something that's closer to New York City. Are we talking 200 basis points, more or less?
We are. In the Capital District, we're probably ranging anywhere from the low 6s to around an 8 cap, depending on the product. And I'm sure you can speak to that 200 basis point or more dip once you get outside into the tier 1 markets.
Well, this is what I call an earmuffs moment for all my friends on this call who buy industrial, because I'm going to tell you a comp we just sold in Southern California. A $300 million portfolio of industrial that had, dare I say it, I'm going to say it, it had a 2 handle on the cap rate, a 2 handle. Now it was a 325 stabilized, but that just tells you in the best markets what people are paying today for industrial. And multifamily, equally, we are seeing cap rate compression in part because of the liquidity of the finance markets. Wouldn't you agree with that, Lori?
Yes. Where the property is, when it's available and it's a good property, which we've had several recently, the banks are willing and the credit unions are willing to do the lending. And with the attractive rates out there, for the right situation, it becomes a good deal for the investors.
Yeah. Well, I did characterize industrial as the land of milk and honey. Multifamily isn't that far behind it, though I will say in central business areas like in Manhattan, San Francisco, and elsewhere, it is struggling from a fundamental perspective. But let me get to the tough asset class at the moment. Not retail, not hotels. Let's talk office. How's that going? Have you been able to sell any assets in office, or do you see any on the horizon?
We've traded a couple of office buildings, but I will go back to kind of the theme that Eric was talking about earlier. There have been medical office buildings. So again, it depends on how you want to classify that. There are fewer of those that have traded locally. But I think depending on the tenants in the building and the length of the lease term, they will be attractive for the investor.
You know, what's interesting about medical office, we've also seen a rise in what I used to call the operational real estate, the outside of the big four. These are things like life sciences. These are things like data centers, self-storage, and single family home rental, all of which used to trade at a massive cap rate discount to the base asset classes. Now the cap rates have compressed to the point where they might be equalized. Are you seeing any trades of some of these peripheral asset classes that I just mentioned in the capital region?
We haven't seen a great number of them, but that doesn't mean that we don't anticipate them coming online in the future, especially as some owner occupiers start to consider maybe doing sale leasebacks.
Sure. And I know you've got some world-class universities in the area, including RPI. Cornell's down the road. I had to throw a shout out there. I'm a graduate, so I know it's a few miles down the road, but sorry, I'm a homer. So in any event,
Orange in my house, so sorry.
yeah. So RPI is their terrific world-class university. And what we're seeing nationally as a trend is that we are seeing new development and actually better pricing in and around the university areas. You seeing that trend up in the capital region?
Yes, yeah, the universities certainly bring a lot to the table in terms of what they offer for our communities. And we do see people wanting to locate in close proximity.
Mm-hmm, mm-hmm. And it really is proximity, because the two scarcest things in the world from a commercial real estate standpoint are, number one, large pockets of talent, and number two, high yielding assets. And fortunately, the capital region can provide both through RPI and the discount you can get from the major markets as well. So final question for you, Lori. Let's take out our crystal ball here for a second. We're in the heat of the moment, to use the Asia song again, and I'll try to come up with a more colorful song before we're done here today. 6 months from now, when we're out of this pandemic, we hope, knock on wood, what do you see as that pent-up demand? Do you see the second half of 2021 being a strong year?
I do. And as you mentioned earlier, with the 1031s being possibly on the table, more people may be interested in getting things done this year. So I do see a strong outlook for the second half.
Good, great. Well, Lori, why don't you stick around? I'm going to invite my other friends back to the screen here. Eric, Dan, John, welcome back. Dan, I don't even know why we invite you to these things, because things are so good in industrial right now. You know, you should just be, you know, the happiest guy on the screen here. But I still, I'm going to show some love for John just the same, because I think that while retail has taken it on the chin, has a very bright future, and maybe even a brighter future because of some of the relocations of people to the region. But let me start with you, Eric, on the office space, because I think I wanted to dig just a little bit deeper there. Because I think the number one question in real estate, as I suggested, is work from home. How much is it going to sap demand? How much is it changing things? Tell me in your words, what are some of the changes you expect to office post-pandemic?
Yeah, well, I'll first start by saying, Spencer, that the office isn't dead. Companies that have been deeply impacted by the pandemic may experiment, like you said, with closures and remote work, but for the most part, office users are going to continue to invest in their office. And the reason is simply because there's a known significant impact on company culture, both creating it and maintaining it, as well as productivity and collaboration. A wise man once said, "You can't fax a pastrami sandwich," right, Spencer? So
yes, I did. So somebody said that, and yes, that is another shameless plug for my podcast. So thank you for that, Eric.
Oh, my pleasure. You know, digital technology is not and should not be a substitute for human connection, which is why the office has a future.
Well, now that we have 3D printing, you might be able to fax a pastrami sandwich, but I don't know that I'd want to eat the first one out of that machine.
No,
So,
definitely not.
Yeah. So, John, speaking of faxing the pastrami sandwich, going back to retail, we have lost a lot of restaurants nationally. Some people think 20, 25%. I presume we're seeing something similar to that there in the capital region. Yes. But you are speaking to tenants, you're speaking to landlords any day. Anybody out there saying, you know what, this is an opportunity?
Yes. So some of your stronger national chains or quick service, they're all out there looking for spaces. A lot of them are looking for spaces to add their drive-throughs. You know, we're going to see the first Chipotle with the drive-through going up in Glenville shortly. That's what's coming. Quick service, get it out the door as conveniently as you can to your customers. It's, you know, Panera did it a couple of years ago around here pre-pandemic. They were, you know, very smart. Added drive-throughs to all their sites. That's what we're seeing. We are seeing food out there, but mostly it's the stronger national chains at the moment. I think the individual restaurateurs are still a little shell-shocked.
Yeah. And right now, what is the percentage of people that are allowed in restaurants? Is it 25% or
50.
it's 50 right
indoor
now?
dining upstate. Yeah, New York.
Okay. And people are allowed in bars. Can they sit at a bar?
If they can get a drink, if they have to order food with it, there's usually like 2 to 3 stools and then a large plastic shield. It's not really conducive to fun, in my opinion. But
Well, there was a great movie with Jack Nicholson. It was called Five Easy Pieces. And the great line from that movie is when he was trying to order toast, he says, "I will have a chicken salad sandwich on white toast. Hold the chicken salad." I'm sure there's a lot of orders like that with people's martinis these days.
there were.
So Dan, let's turn to you now. Dan, you know, I don't even know why I'm asking you questions. It's so good for you right now, Dan. Look how happy Dan is. I mean, everybody up here is, you know, fighting the fight, but Dan's like, it's my time. But I want to talk about some of the peripheral areas of industrial, specifically as it relates to the convergence of industrial and retail. And there's a lot of ways we talked about it. We talked about four-wallers, about these hybrid stores. We also could talk about cold storage and its competition with grocery stores, because grocery stores really are a four-waller where goods can come out of the back. What are you seeing there in terms of these hybrid stores, cold storage, or four-wallers or otherwise?
I'll say not much yet, with one notable exception. We did see in the fourth quarter of 2020, the conversion of a former sportsplex in southern Saratoga County that was purchased by a manufacturer. And that building, about 76,000 square feet, was purchased for $5.5 million. That's probably one of our more recent, notable, and outstanding examples of fixing the problem of a constrained supply. And while, yes, I am smiling, Spencer, because the industrial market is good, it is strong, the fundamentals are in place for that to continue for the next 11 months and beyond. The good news is the bad news, and that is we have that limited supply to meet the demand. The calls come in, the users tour the area with us and the industrial brokers in the market, and they say, you know, where are all the buildings? Well, we can show you one or two, and by the time we sit down for our pastrami sandwich, one of those two might be already leased or already purchased. So not to take away from your father's advice of slow and steady wins the day, here in the industrial market, I say that speed wins the day. And users and occupiers have got to act quickly. I'm optimistic we'll see more conversions in the future, because we are in fact supply constrained. And again, that was one of the more notable and apparent examples that we saw in late 2020 up in southern Saratoga County.
Well, that supply constraint, I think, also applies to the capital markets, where there just isn't enough industrial assets out there. There aren't enough apartment buildings out there. So to quote Led Zeppelin, your time is going to come, Eric, and people are going to have to shift back to buying office buildings, because it is by far the largest asset class. And I believe the pendulum has swung too far in the wrong direction. Would you agree with that, Eric?
Yes, and I think there will be great deals to be had in the office market as far as investments go in the future. Absolutely.
So, Laura, let's turn to you then, because I know the office market outside of medical office has been very constrained, not just from an equity standpoint, probably even more so from a lending perspective, where we're not seeing, it's very difficult to get loans. But let's just talk about the lending market a little bit deeper now. When you are getting loans out there, where is the money coming from? Is it local banks, the money center banks, or otherwise?
We are seeing a large percentage with the local banks and credit unions versus the national banks. And a lot of that is because the local institutions know our market, they believe in it, and especially when it comes down to our local investors, they know them and have great relationships.
Are you seeing any debt funds up there, any non-traditional lenders?
Not a lot. Yeah, that's fairly limited.
Well, they're coming, and I'll tell you why they're coming. Because right now, going back to this concept of pent-up demand, right now there is just not enough deals to put the money out. And I was on the phone yesterday with some of the leaders of the hotel industry. We're seeing the cost of funds from debt funds come in 50 basis points a month. That's how aggressive it's getting. And this is an asset classes like hotels, and yes, John, like retail. So we're seeing the money come in. Once the money come in, the equity investors will come back. Well, we got about 4 minutes left here, and I'm going to now go to the outlook section of today's conversation in lightning round fashion. And I'm going to ask you all a same or similar question, starting with you, Eric. It's always darkest before the dawn. And I'm going to try to come up with another funny song reference, but the second half of 2021 and beyond, what's your outlook for the office market?
I think we're going to see more of the same, which is short-term decision-making because of the uncertainty, but there is light at the end of the tunnel, and our vacancy rates will come down.
Okay, thank you, Eric. John, same question for you. Outlook in 2021, second half of the year and beyond in retail.
I see a slow and steady recovery. A lot of it based on vaccination and getting customers back in the stores.
Mm-hmm. Well, you know, slow hand, Eric Clapton was considered the greatest guitarist of all time by many. I still think Jimmy Page is better, but that's just my personal preference. Dan, land of milk and honey, second half of 21 and beyond, what do you see for industrial?
Continued and sustained increases in lease rates, further diminishing vacancy rates. We've got the downstate push upward by users. We've got a environmental policy that was put in place by the governor in 2019 for offshore wind production. We've got some fundamentals in place that will continue to take us in a strong and robust direction through 2021, and I think clear into 2022.
So like the Lionel Richie song, will you be dancing on the ceiling come 2022, given how good it is? And by the way, Lionel Richie is not only one of my favorite singers, my favorite Commodore as well, but is the land of milk and honey going to continue, Dan?
I think it is. I don't think online shopping is going away anytime soon. We've gotten very accustomed to it. The pandemic's increased our familiarity with online shopping. That, of course, drives e-commerce, third-party logistics, and last mile fulfillment, and some of those other fundamentals so deeply entrenched and in place that I think we will, in fact, be dancing on the ceiling for the foreseeable future.
Well, Lori, to you, the money question from either Pink Floyd or Cyndi Lauper, who said money changes everything. Are we going to see money continuing to flow to the capital region in the second half of this year and beyond?
I think we will. I anticipate that the momentum will continue, you know, especially when you talk about cap rates for industrial, like you just mentioned, being, you know, in the 2s, and we're in the 6s or 7s. Albany's the way to go.
All right. Well, for those about to rock, which is the second half of 21, we salute you. And with that, thank you very much for the opportunity to share some ideas about the capital markets, about office, retail, and industrial. Future is bright nationally. The capital region will benefit from it second half of 2021 and beyond. And for the final thoughts, I pass it back to Rich Sleesman. Are you going to say a few final thoughts, or are we signing off here?
I'll be happy to share a goodbye, Spencer. Thank you. So let me just close out by thanking you all for joining us today. This has been one of the more unique years in my 35 years of working in the sandbox in commercial real estate in the capital region. And I'm glad you could all join us today. Thank you, Spencer, for being our moderator and for taking us through the conversation. And to our panelists, Lori and Eric, John and Dan, for your insights into the various silos. Let me quickly thank also Carrie Field and our entire staff here at the office for all the work behind the scenes, pulling this off. It worked out really well. I have a lot of songs to reference, but I'm not going to do anything. I think we're done with the songs today. So again, let me thank everybody for joining us. We'll see you out there soon. Hopefully in February of 2022, we are live in person again, sharing a drink as well as the conversation we have here today. And we'll be getting our reports out to all of you very soon. Thanks again. Have a great day.
Thank you.